And as usual, we have quite the lineup for you, starting with Ben Streater from Stropro. Just a little on Stropro first. It is a platform that enables investors and advisors actually to access a wide range of alternative investments using what's called structured investments. Now, these investments use derivatives for downside protection, income, and plenty more besides. And so to tell us all about it, a very warm welcome to you, Ben. Thank you so much for joining us.
Thank you, Nadine. Pleasure to be here.
Look, options are one of the most, I guess, popular types of derivatives that are used. So let's, if you don't mind, start with the basics. What are options and why do investors use them?
Brilliant. So options are a type of derivative contract. Option holders are usually using them to do a number of things, but typically an option gives the holder the right to buy or sell a particular asset before a certain date at a fixed price. Now, options give investors flexibility to express different market views. It could be that they're bullish, that they're bearish, or even having a neutral view. Typically with options as well, they come in two forms, calls and puts, and there are, for each option, there's a buyer and a seller. Now, rather than going through complicated payoff diagrams, I think it's quite useful to try to understand the different investor profiles that are out there, using options day to day. So yeah, we do have an image.
Okay, good, great.
There available. So up the top there, the top row they're the buyers of options. So we have call buyers. So call buyers are generally quite bullish in nature, and they're effectively seeking to get upside leverage to the market. On the other hand, we have put option buyers. They are a little bit more bearish in nature. Most option buyers are looking to protect an asset. Some even refer to it as buying an insurance policy over an asset. If shorting your market's your thing, you can also buy puts to short the market. And then we have the sellers of the options, and the primary objective of option sellers are to generate an income stream or to generate yield. So call option sellers, they are happy to sell an asset if prices were to rise. And in exchange for that risk, they would be paid an option premium or income. And then with option sellers, they are willing to buy into an asset if prices were to fall, again, taking an income stream in exchange for that risk.
Okay, so you have to have a view on the market and where you think it is headed. And so when we're talking about extracting yield via derivatives, that is from being on one side
the sell side.
That sell side, one side of that view.
Exactly right. That's exactly right.
And so income can look like what?
Usually it's an upfront premium, so an option seller can literally write an option into the market, and right away they'll be paid an option premium, and that's effectively income in their pocket that can't be taken away. Then they're going to have some obligations at the back end.
Yeah, okay. So what are some of the common option strategies?
Brilliant. So in addition to those kind of 4 directional strategies that I just went through, investors can also blend stock and option positions together, and they can also take 2 option positions in tandem to create a strategy. Some of the common strategies are collars, where investors are buying a put and selling a call and looking to profit in between. We've got covered calls, and a very popular one that the viewers might have heard about, where you own the stock and you're writing calls typically above those levels to generate income stream. And those that might have a directional view on volatility itself can create positions like straddles and spreads to profit from movement in volatility.
Yep, so there's lots of different options out there, but forgive me, it might be a bit challenging to get your head around all that, to utilize those strategies yourselves, correct?
Correct. So I might just go through a few challenges, right? Because you're right that there's a bit going on. and options do require, active oversight and active management. Looking for, you need to be observing, option expiry day, your margin commitments, collateral management as well. Things can get quite complicated quite quickly. And then, having another challenge in the market is liquidity.
Yeah.
And I think there was a question from one of the viewers about liquidity. And look, if you're sticking to, large cap stocks or the largest cap stocks in Australia, there's generally enough liquidity to be able to put option trades on. But, one of the challenges, if you are going beyond that, or beyond a certain time frame, the sweet spot in Australia is typically between 3 and 12 months. If you're going beyond that, that can cause challenges because there might not be someone on the other side to take your option position.
And I think that was a question from Sue. Thank you, Sue, for writing in ahead of time. We are taking live questions from our audience. Sue also asks if the options market is growing here in Australia. What's your sense?
We're certainly seeing a lot of growth on the structured product side.
Okay.
I'm not too involved in the day-to-day trading of options. I think I suspect that some of your next guests will certainly have a view on that.
Okay. You've got this TV thing down pat. All right. So those are the challenge if you're attempting to use options directly. So there is an alternative for those who want to sleep at night.
Yeah.
I think that's a really important factor, particularly if you're dabbling in something that you're not overly familiar.
Yeah.
So what is that alternative?
So an alternative to trading options directly are structured products. And what they are, they're instruments or investments issued by large global investment banks, and they're effectively pre-packaging these notes that are reflecting the same strategies that we were talking before, plus more, with the benefit being that it's institutionally managed. So it's the onerous is more on the investment bank than the investor to get these option positions right. So I can run through some of the benefits of structured products, being that they can be simpler than trading options directly, given that you're effectively outsourcing. You come up with your idea, share your view, work with a team like Stropro, and we can effectively implement that view. And then the ongoing derivative management is actually handled by the investment bank.
So like investment banks that we would know?
Yeah, the Citis, Morgan Stanley, UBS, all these types of banks that we have on our panel at Stropro.
Okay.
We've got greater coverage. We mentioned that there can be some constraints with coverage. Using the global investment banks, their global presence, their global trading teams, we're able to go much further beyond what might be available on listed markets or listed exchange traded options anyway. Then we've got flexibility. We mentioned some time constraints as well. Using structured products and their capabilities, we can go from anywhere from 3-month strategies all the way up to 10 years, depending on what investors are looking for. And then currency hedging. If you're looking to trade options into an international market like the US, currency risk becomes a factor. But one of the benefits of structured products is that you can invest in Aussie dollars and have that hedged, even though you're getting exposure to offshore assets. So that's one of the other benefits. And one last one is around unlocking liquidity. And this is an area of interest that we've seen a lot of lately, where investors and advisors are coming to us with large single concentrated stock positions. And we can, with the investment banks, we can arrange a strategy over that stock, write an option. It's typically a collar, like what I mentioned before, and we can release up to 80% of the value of that stock, protect the downside, and release that in cash. Investors can then diversify those funds into other things.
Okay, so that, you've alluded to it, that's an example of Stropro using derivatives. So you're using it for income, you're using them from downside protection, you're using them leverage as well?
They can, yes, call option buys are generally leveraged, that's right.
And so talk to us a little bit more about what Stropro does and how you use derivatives.
So we our job is really focused on the advisors and the investors that we look after and trying to uncover what types of views that they're trying to express in the market, whether that be a bullish view, a sideways view, a bearish view. Are they looking for income or growth? From there, we will take those preferences and permutations and arrange those views effectively with investment banks. So that process involves quite a bit of ideation and design, product design to express those views. And then what the investor's left with is effectively a term sheet from one of the banks that specifies the risks, specifies the benefits, and it's quite clear what investors are getting involved in.
Well, we've had a question come in from Bruce. Thank you very much, Bruce. We are thinking alike because this was my next question too. Can you give us a simple example?
Absolutely, please? Sure. So let's say that we've got an investor whose primary objective is to generate income. And let's also say that they've got a bit of a favouring for US shares. Let's go with Apple, Microsoft, Amazon. Mm-hmm. And let's say that this particular client, he likes these stocks, but he thinks markets are a little bit overvalued and would prefer to maybe enter these stocks at, say, a 20% discount from today's level. So using a structured product, we can arrange a strategy, essentially over that. So we've got an example here. It's in AUD despite being in US assets. We've got a coupon rate here of 10% per annum. That's paid quarterly along the way. It's a 1-year term. It's got a strike price of 80%. I might touch on that in just a moment. I mentioned the shares, Apple, Microsoft, Amazon, and it's issued by an A-rated global investment bank. So what's happening here on the right-hand side of the screen, you can see that there's, that income of 10% per annum is being paid quarterly. And then we've got sort of two scenarios. What happens if markets rise? What happens if they fall? Mm-hmm. So the blue line, scenario 1, is just illustrating a situation where all 3 shares finish in positive territory. In that case, you've collected your 10% along the way and you receive your 100% of capital back at maturity. Mm-hmm. Scenario 2 is where one or more of the shares has fallen below that 80% strike level. And what that means is they would then enter into the market and effectively take ownership of that stock. So in either case, it's still a bit of a win-win for the investor because they've either got their coupon and their cash back, mm-hmm. or they've got their coupon and entered into the market at a 20% discount. I think Anto might have spoken about smart entry notes previously on the show.
Yeah, that was a while back, yeah.
Right,
yeah.
And this is exactly one of those examples.
Yeah, okay.
Very popular.
So then you own that stock, but you've got it at a 20% discount from where you had entered that structured product, that structured investment.
Right. Yeah.
Okay, I'm getting it. And why, just flesh out a little bit why structured investments are most suited to wholesale investors.
Okay. So it's a little bit of a similar case to bonds. It's quite difficult for retail investors to access the paper of corporate bond and government bond issuers. Similar situation with structured products. If you're looking to get direct access to the issuers and own that paper, it is restricted to wholesale clients in Australia. Having said that, there are providers of retail structured products out there in Australia, but they are a little bit more generic in nature and a little bit less tailoring going on. So if you're looking for something more personalised, wholesale structured products is kind of the space you need to be in.
Yeah, okay. And you alluded to advisors. So do you service advisors as well? Or can people go to their advisors and ask about this?
Both, absolutely. Okay. So we advisors are a core focus of ours at Stropro. They like the platform experience. They can come to the platform for education. They like the fact that they can execute digitally, and they appreciate the advanced and quite enhanced reporting that we're providing on structured product positions. On top of that, we integrate with a lot of the Australian wrap platforms and wealth administration platforms.
Like Hub24, Net Wealth and the like.
Exactly right. So that means that an advisor can still work in with us, but then we can sort of push that reporting through to their main platform, which consolidates the administration for the advisor.
So if somebody's viewing right now, they can contact you or go to your website to get more of that education piece, or they can go sort of push their advisor.
Absolutely.
Okay.
Yep.